The global surge in e-commerce has prompted countries like Malaysia, Singapore, Australia and New Zealand to adapt tax policy for low-value imported goods. Malaysian introduction of 10% sale tax on good value below RM500 also aimed to level the playing field for local retailers against untaxed import and bolstering domestic competitiveness. Similarly, Singapore, Australia and New Zealand have implemented measures such as GST on import to ensure fair taxation and support local business. This effort underscores a global trend toward harmonizing tax policy in the digital economy, reflecting a commitment to equitable market conditions and suitable economic growth.
Passed in August 2022 by Malaysian Dewan Rakyat effective in 1st January 2024, exposed a 10% sale tax on online transaction of low-value imported goods (LVG) costing less than RM500. The aim is to address tax treatment disparity between online and traditional retail businesses, especially benefiting micro, small and medium enterprises. Previously, goods below RM500 were exempted from import duties and sales tax, giving online businesses an unfair advantage over local retailers. Similar measures have been implemented in neighbours countries like Singapore from 1st January 2023 and Indonesia 1st April 2023. Announced in Budget 2022, the sales tax legislation for LVG was delayed from 1st April 2023 to allow for stakeholder consultation on implementation challenge, ensuring fair competition in Malaysia. Effective 1st January 2024, LVG imported via land, sea and air valued at RM500 or less will incur a 10% sales tax, excluding items like cigarettes, tobacco products, intoxicating liqueurs and smoking pipes, which already face import duties, excise tax and sales tax. Online sellers, domestic and international, exceeding RM500,000 in LVG sales to Malaysia annually was registered under the Sales Tax as amended 2022. Registration ensure compliance with tax regulation with invoicing requirements with Malaysian Malay or English, date of invoice, serious number, seller's names, address and registration number. The amended aim to level the playing field for local retailers by ensuring that all businesses pay their fair share of tax, thus supporting the Malaysian economy and stabilizing the local currency, ringgit.
Singapore, known for its disruptive approach to adapting tax rules to the digital economy, took a key legislative move on 1 January 2019 when it extended its goods and service tax to encompass imported low-value goods valued at $400 or less. The $400 threshold was carefully determined to create a balance between revenue consideration and administrative simplicity. Goods imported below this amount are charged a 7% GST, ensuring that this transaction contribute to the national revenue stream. This extension improved compliance and administration for both consumers and businesses by easing the process of applying and collecting GST on imported goods. One of the objectives of Singapore's GST extension is to generate tax fairness between domestic enterprises and overseas e-commerce platforms. Before this legislative reform, low-value imported items had a tax advantage over domestically sold goods, resulting in a competitive imbalance. Singapore intends to level the playing field by submitting these imports to GST, encouraging customers to consider local options and supporting the viability of domestic enterprises. The impact of Singapore's GST expansion of consumer behaviour and market dynamics has been carefully regulated using the $400 threshold. This level ensures that consumers continue to have access to affordable imported items while also keeping tax liabilities clear and manageable. Singapore's economic policy demonstrates its dedication to assisting local enterprises and promoting long-term economic prosperity. By lowering untaxed imports' competitive advantage, the GST expansion promotes a more balanced consumption, pattern that benefits both consumers and local businesses. This strategic alignment of tax policy and economic objective maintains Singapore's competitiveness in the digital era while also fostering fair competition and consumer welfare.
First, GST information before 1 July 2018, products worth at AUD 1,000 or less were exempted from GST when imported into Australia. This exemption permitted overseas merchants to sell items below this threshold without incurring GST, which harmed local business who were obligated to charge GST on all domestic sale system. Transparency versus Australia LBIG system ensure complete transparency by incorporating GST in the purchase price, but Malaysia method with consumer ensure of the total cost until the products arrive at customers. Objective in the changing world of global e-commerce, nation must change the firm. Both Malaysia and Australia have imposed a tariff on low-value imported items with the goal of curbing tax evasion and providing a fair playing field for domestic enterprise. To show this fundamental distinction influence consumer happiness and trust, Australia and Malaysia have imposed a tax on low-value imported items to achieve similar goals. The methodology's difference is term of tax threshold and collection mechanism.
New Zealand introduced GST on low-value imported goods on December 1st, 2019. In New Zealand, the GST rate is 50%, applying to goods valued at $1,000 New Zealand dollar or less. Offshore suppliers must register if their annual supplies to New Zealand exceed $60,000 New Zealand dollar. This policy aims to ensure fair competition between local and foreign suppliers. While Malaysia imposed a 10% sales tax on goods below RM500, this covers a broader range of products compared to New Zealand and significantly impacts consumer behaviour and e-commerce activities. Malaysia's 10% sales tax may lead consumers to switch to local products or reprioritize spending to avoid the tax. In New Zealand, the highest 50% GST has a stronger influence on consumer choice, encouraging a preference for local products. In conclusion, New Zealand 50% GST ensure competitive fairness between local and foreign suppliers, while Malaysia lower threshold covers more products influencing consumer behaviour. Both countries benefit from improving administrative system. Overall, the New Zealand higher GST promote a greater preference for local products.
So, what is the impact of sales tax on online purchases of imported low-value goods prices below than RM500 to buyer, seller and Malaysian economy? First, to the buyer, the price of goods will be increased according to 10% of imported tax. It is because the goods from abroad sometimes cheaper compared to the local product even though the brand and the quality may be same. Second, the buyer will change to local product. It is because the price is more cheaper or sometimes more faster to get the goods compared with the goods from the abroad. Next, the impact to local seller. Seller will compete in fairer competition. Before this, local seller had to compete unfairly with foreign seller because the price of imported goods was much cheaper because there were not taxes. So, local sellers now have the opportunity to compete more fairly in a more balanced market. The second effect on local seller is the increase in sales of goods. This is because buyer may switch to local product whose price and quality are almost same or same as imported product. This will have a positive effect on the local economy and support the growth of small and medium enterprise SME in Malaysia. Lastly, from a Malaysian economic perspective, the income will be increased because buyers change their preferences to buy local product. Other than that, it is because of the LVG that government charge on imported product. The tax will be used for SME, for example, in terms of financial assistance or development project or other that will be drive national economic growth. Next, it can control the dependencies to imported product. This is in line with the government effort to promote local industry and reduce the trade deficit. In addition, if we depend on imported product is not controlled, it may lead to the decrease of dependencies and production of local goods in Malaysia.
In conclusion, Malaysia, along with Singapore, Australia and New Zealand, has introduced sales tax on online purchase of low-value goods below RM500. This reflects a global trend to online tax policy with e-commerce growth, aiming to expand tax base, support local business and ensure fair competition in the digital marketplace. Despite varying approaches, based on condition, this reform share the common goal of fostering tax equity, stimulating economic growth and adapting regulatory framework to the digital era.